Welcome back, everyone. Today's video is going to be my attempt at a critical assessment of one of my holdings, VoXTuR Analytics. So I do want to start this video with a bit of a warning that some people who like the company, or some people just in general, might not like all of what I have to say. I will be both positive and negative, and I do want to point out that the comments or criticism that I employ is not targeted at people making a case, just at the arguments made. Again, with the disclaimer, I own shares in VoXTuR. It's a very early stage company. It's a relatively large position considering the stage of the company it's at. It's a speculative investment, and it's definitely not for everyone. This is not investment advice. So I just wanted to clarify, this video is not a detailed look into the company. There is plenty of great information out there, and if you're more interested in VoXTuR, there's plenty of places where you can find the story and details like that. I will be looking more at the investment thesis and the financial side, but just to quickly cover things, VoXTuR is a real estate services company, software as a service. That's important to some. It's growing hopefully very quickly, and as they are rolling out multiple product offerings and growing their existing offerings. There is tons of discussion out there. That's what I'm mostly referring to here, but not going to go into all the details. You may forget this at points in the middle of this video, but I am bullish VoXTuR. I think their platform that they're building has the potential to be quite valuable. I think that their services have a good chance of being widespread and adopted pretty broadly throughout. They offer a very deflationary service, which allows people to do much more with their existing resources. And for that reason, I think it has a good chance of having success. Now, the degree of that remains unknown. As I said, it's an earlier stage company. However, I believe in the value offering, and that's why I'm bullish. But there are a number of bull cases that make me uncomfortable. So first, let me give you the mock-up of a bull case that makes me a bit uncomfortable or slightly combative if I wanted to debate. So some might say the company is cheap and only trades at some low number of times sales. They're only this cheap or relative to peers because they're trading on the TSX Venture and not the Nasdaq. If it was off the Venture, it would be trading at a much higher multiple. There's companies with this level of growth should trade at whatever, and look at the story, so on. Okay, so the first thing that I dislike is I really don't like blaming exchanges for valuations. A few years ago, a year and a half, VoXTuR went up 1,000% on the TSXV, and they still don't make any money, still don't make any net profit, and yet it went up 1,000%. And apparently tech stocks on the TSXV don't get proper recognition, but there are other big tech stocks. Multi-billion-dollar Topicus surged more than 100% right after their listing. Multiple ad tech companies surged 300 to 500% a few years ago. And in general, if a company looks like it's going to make money, the share price will go up. Now look, I don't expect the uplisting, when it happens, if it happens, to hurt, but I also would not expect it to magically change things. It's an incredibly discussed piece of news, so that type of thing normally gets priced in and really rarely results in a sustained bump. I really just don't like this type of thesis because it amounts to saying that somebody less sophisticated less sophisticated money will come and bid up the price to a higher multiple just because I guess they couldn't access it or hadn't heard whatever, and now they're magically going to hear about things. It's a type of thing where if this were the only thesis, I definitely wouldn't own the stock. But look, I do agree there are reasons why the TSXV lacks some credibility at times with some companies. Why? Well, because sometimes some people don't like penny stocks. A lot of people get very uncomfortable around paid promotion. Lots of companies issue tons of shares. Many companies have no profit or net income at least. And a lot of the companies have high general and administrative relative to their profits. But these aren't exchange things. These are certain companies on the exchange things. Now, look, I'm not going to say that the Nasdaq companies don't get higher valuations because many do. But if you also look at what's happening recently at the Nasdaq, is companies are imploding from these absurd and ridiculous valuations that some had. Some didn't, because some make money. But the thing is, you look at some of the ones that didn't make money that were trading at very generous sales multiples, and some of them are down 70%. And some of them may fall another 70%. Because if you don't make money, there's no floor beneath what the market could decide you're valued at. And this kind of the situation reminds me of, that saying, well, if all your friends jumped off a bridge, would you jump off a bridge too? No. And you look at VoXTuR, while many of these companies have fallen 70%, VoXTuR's flat. Why? Well, because it didn't have the same type of ridiculous valuation that some other companies did. And in my opinion, the fact that it's flat in this market also gives you some type of message. Which gets me to my next point in terms of looking at price to sales multiple and saying it's cheap based on that multiple. Well, in my opinion, that multiple doesn't mean a whole heck of a lot. Now, I know that some people will talk about eventual margins on those multiples and how revenue growth will eventually lead to profit growth or whatever. But frankly, if a company doesn't make a profit, it's a speculation and not an investment. Now, there's nothing wrong with a speculation. You can make more money on speculations than investment. But if you're talking about a company being worth something, a speculation is a speculation because it's hard, almost impossible, to say what it will be worth. And so when you're talking about a price to sales multiple, that's doesn't really help you determine what a company is worth, and so it's hard to say that it's cheap. So let me look at a bear case. If a bull were to say, look at it's cheap based on price to sales and the growth and all that, whatever, let me counter, because I think it's very important to understand why this company looks the way it is. You could say, oh, look at all the growth potential, look at everything, and why is it cheap? This doesn't make sense. Well, let me point out, maybe it does. And here's how the company screens. You look at the company and, a bear would say, look at the guidance. What growth? That's the run rate today. So why should we pay a big multiple if based on, Q4 run rate at a little bit more, there's not a lot of growth. Now, maybe in the end, which I do believe as a bull, I believe that eventually we will exceed that growth or those sales and continue growing in the future. But looking at guidance, looking at what people are seeing as they casually look at the company, what growth? And if you look backwards, there's no profitability either. There's a profit, but they're after the SG&A and all the other expenses, there's no profit. Or there's no net income, I should say. Look, they did grow. Looking back, they did grow. They grew their share count. They almost, more than 4x their share count in the past year and a bit. So yes, they grew the revenues, but again, look at the share count. It grew right along with revenues. And again, this is me, a casual outsider looking in. You don't need to tell me about the story. You need to show me the story, and I'll get to that in a bit. And there is also, associated with the company, been a bit of promotion. Now, some of this is necessary, arguably, or useful to keep the cost of capital low, but it also is associated with a certain type of risk that some might look negatively upon because it can spiral the other direction as well. So you mix all this, the no profit and all this stuff, with debt that is approaching or beyond covenants, and that looks scary. Now, look, again, this is intended to be a bear case to point out why the company does not screen well today, why someone, a casual outsider looking at the company, would say no. Because in order to understand what it takes for a casual outsider to say, oh my God, yes, you need to fix what's wrong with the company. Now, in order to make this investment work, to make this company work, to make this, what most people seem to care about, share price work, it's honestly, in my opinion, so simple, it's boring. Forget about the fancy terms like SaaS and business to business, BTB, attorney opinion letter. Forget about all that. Forget about revenue or sales growth. The market doesn't care. What the company has to do to get the share price higher is make money. If they do, they will deserve a valuation. If they do not like that valuation, well, they can buy back shares and compound their future success. Also, if they make money, that debt becomes less of a skull and crossbones and more of a, well, that's fine. It's just a business. It's part of a business. That it's really simple. When they make money, when they make more money, and when the market looks at the company like, oh, this is growing, the share price will go up. Because in the end, what matters is not analyst projections, not investor projections, or company projections. It's reality. So, forget about optimistic hopes, forget about dreams, forget about peer valuation or margin percent or anything. If the company executes, and if they execute, that means they will make a lot of money or some money or however much money, then they'll be worth something. Until then, valuation is arbitrary, and the market is trying to figure out how much they may make. And, that could point to a lot. Or if, maybe they decide that the best strategy is to find a way of growth where they make very little profit in the meantime. Okay, that could work best, but it could also mean that the market keeps thinking maybe they're worth zero. And so the valuation is somewhere in the middle. Now, why am I going into this for the first time on this channel, the first time I'm going into detail on a dedicated video on VoXTuR? Why now? Because I think, and arguably I hope, we are close to a tipping point. Going forward, I think there's a shot that the run rate from, well, very soon, I don't know if it's Q4 or Q1, hopefully not as far as Q2, but maybe. I think the run rate from there should make it so that the valuation so that there's EBITDA, and so that the valuation of the company today is essentially worth that, which would mean that growth from there, assuming the growth translates to, if not the bottom line, EBITDA, means increased fundamentals backing and valuation for the company. I think we're close to the point now where the growth goes from catch up and the company goes from potential good story to a good growing profitable company. And when that transition happens from potential to good and growing, I think the market can start looking forward in a more in a way that allows it to think the base case is less growth and the bull case is more growth, as opposed to the bear case is bankruptcy and the bull case is growth, and so valuation kind of somewhere in the middle. Now, don't get me wrong. I do think that once you pass the tipping point and get to a profitable company, there is room for multiple expansion. But in order to have a multiple, you need something to multiply and something that matters. And to me, revenue or gross profit for that matter, don't matter. And similarly, if you're looking at gross profit margin or gross margin, 20% versus 70% really does not matter much if none of it gets to the EBITDA. But as the company expands, as more and more of the margin is converted to EBITDA, which I hope is starting to really kick in, then you should see the EBITDA margin. Well, that finally a margin that actually matters, or net margin. But anyway, after all that rant, kind of like with companies, what really matters is the bottom line. And, I could be persuaded to say, okay, it doesn't have to be the absolute bottom line, but some type of earnings power, that could be EBITDA, that the company can use for acquisitions, for example. Now, a few things I would like to see in the upcoming year are some more and increasing gross profit conversion to EBITDA. And if we are at the tipping point, we can see, hopefully, a fair bit of that and accelerating going forward. Hopefully, we could also see some organic growth beyond essentially the current run rate. Now, if we want to have some accretive acquisitions along the way, that's fine, but it would be ideal to me if there weren't share count increases that go along with those acquisitions. And ideally also there weren't increase in the G&A expenses. Now, some may wonder, how is it possible to acquire companies without increasing the share count? And the answer, I would say, is the beauty behind another Canadian software company, and that is when you make money, you can buy things. And hopefully all of that kind of comes together, and along at the same time, you see the debt stop becoming an issue, and it just would come together. So in the end, despite this stock being on the TSXV, there is quite a buzz amongst some investors, and there's many excited parties that are, well, linked to the stock. Now, that's fine, but really what this investment needs is for people to just chill out and be patient. If it goes well, we'll get there. If it in the end makes the money, then it will get a multiple, and the stock will go up. You look at the big companies, and even then, when it comes to multiple, they're all mean reverting to basically approximately the same thing. So if a company in an early stage gets a really high multiple because they're growing very quickly, well, eventually that multiple shrinks. So, you know, either way, it will take time, and patience, just patience, really needed. Anyway, if it's truly great and it's truly cheap and along the way, well, it's profitable, well, then the company can buy back shares and compound their future success. It's just that simple. And at the same time, if they're more expensive than something they're acquiring, they can issue shares to acquire it, and it could do well for them or both parties. But in the end, if you're egregiously cheap, you don't issue shares to buy things, and vice versa. Anyway, that is my bet and where I think we are with this company. I could easily be wrong. It's been known to happen. And, this isn't my normal type of stock that I generally follow or cover. So it's possible my understanding of the company or strategy is wrong. But this is just kind of how I look at companies, look at businesses. And again, it's just an opinion. And with that and $5, you can barely afford a coffee anymore. Thanks, inflation. Anyway, in the end, that's all. Thanks for watching. I think this is enough thumbs down and subscribers lost for one day. Hope you enjoyed, though. And until next time, have a good one.